Need to use the money anytime soon, you should not invest in stocks. This is money you're willing to put in the market and leave. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold.
Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold.
Peter Lynch is often regarded as one of the greatest investors of all time, but there's one thing about his career that still baffles many. After achieving legendary success as the manager of Fidelity's Magellan Fund, he simply disappeared. At the peak of his fame, with a reputation that was untouchable and an investment record few could rival, Lynch chose to step out of the spotlight. He went off the grid. No press conferences, no public appearances. For years, no one really knew what he was up to. While the world wondered what had happened to the man who had turned $20 million into $14 billion, Lynch was busy living a quieter life, focusing on things other than stock markets and financial forecasts. His decision to disappear from the public eye became as much a part of his legend as his incredible performance as an investor. But even after his departure from the world of high finance, Peter Lynch's legacy lived on, not just in his books but also in the strategies and philosophies he left behind. His unique approach to investing had not only changed the way people thought about the market, but it also challenged the idea that professional investors held all the secrets to success.
Back in the 1950s, a fireman from New England noticed a factory in his town seemed to be hiring and expanding all of the time. He decided to put $2,000 per year into TAM brands, then called TAM Packs. By 1972, the fireman was a millionaire.
Welcome to Capital Chronicles, where we aim to dive deep into the stories that define the world of business, both the triumphs and the stumbles. Our goal is simple: to educate and inform. Through short, engaging case studies like this one, we're peeling back the layers of companies, products, and decisions that have left their mark on the business world. Whether it's uncovering what makes a startup succeed or analyzing how a billion-dollar idea went belly up, Capital Chronicles is here to help you understand the lessons behind the headlines. If you love exploring the dynamics of business, the strategies of companies, and the stories of those who dared to dream big, then this is the channel for you. Born in 1944 in Newton, Massachusetts, Peter Lynch's early years were shaped by hardship. His father passed away when he was just 10 years old, and Lynch learned the value of hard work from a young age. His first job was as a caddy at the Braeburn Country Club, where he was exposed to the world of business and finance. A chance encounter with George Sullivan, the president of Fidelity Investments, would become a pivotal moment in his life. Sullivan recognized Lynch's potential and brought him into the world of finance, giving him a chance to start his career in investment research. After earning his degree from Boston College and serving in the Army, Lynch joined Fidelity Investments as a research intern. It wasn't long before his talent was recognized, and by 1977, Lynch was named the manager of the Magellan Fund, which at the time had only $20 million in assets under management, AUM. But Lynch's impact on the fund was immediate. Under his leadership, the fund grew exponentially, reaching $14 billion by 1990, with an average annual return of 29.2%, far outpacing the broader market. This performance made Lynch a household name in the world of investing. His core philosophies was that individual investors had an edge over professionals. While Wall Street's analysts and hedge funds were buried in technical reports and complicated models, Lynch believed that the best investment ideas were often right in front of ordinary people. He famously said, "Invest in what you know." His strategy was to find companies with potential growth that he could easily understand and that had products or services that he could observe thriving in everyday life. He believed that everyone, from a teacher to a dentist, could find great investment opportunities by simply paying attention to what was going on around them. Peter Lynch's most successful investments were a direct result of his philosophy of investing in what you know. He wasn't afraid to make bold bets on companies he believed in, even if they weren't popular or well known at the time. He also embraced a strategy of long-term investing, often holding on to winning stocks for many years, letting the value compound. One of Lynch's first big successes came with Dunkin' Donuts. During the late 1970s, Lynch noticed that the Dunkin' Donuts stores he passed on his way to work were always busy. He decided to investigate the company, diving into its financials and business model. Dunkin' Donuts was poised for growth due to its low-cost structure, high profit margins, and growing customer demand.
I owned Dunkin' Donuts for 12 years. I think I might have talked to him once every year. The story didn't change a lot.
I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts.
He invested heavily in the company, and over the next 12 years, Dunkin' Donuts returned 15 times its original value. This was the beginning of Lynch's reputation for spotting 10 baggers, stocks that would increase in value by 10 times. A successful investment came from a company that many thought was a niche business, Volvo. Lynch had purchased a Volvo car for his family and was struck by its high safety standards and durability compared to other brands. He investigated the company further and found that its stock was undervalued and overlooked by the market. Volvo was a strong growing company with a unique position in the marketplace, and Lynch bought in. Over time, the stock appreciated significantly, rewarding him for his insight, cornerstone of his career. Through smart investments in companies like Tampax, Ford, and Gillette, Lynch demonstrated an uncanny ability to pick companies that had strong fundamentals and a clear path to growth.
But you have better stock picking skills than you realize, and you have advantages that no one on Wall Street has.
So in your own industry, you're going to see a lot of stocks, and that's what bothers me. Let's say you're an auto dealer the last 10 years. You would have seen Chrysler come up with a minivan. You could have made 10 times your money on Chrysler a year after the minivan came out.
His investments weren't all home runs, but Lynch always saw the market as a place to find both winners and losers.
What you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know.
Famous for making quick decisions to cut losses when a stock wasn't performing as expected. His approach to selling was as straightforward as his buying strategy. You have to sell when the reasons you bought a stock no longer apply. One of the keys to Lynch's investment success was his ability to look beyond short-term market movements and focus on the long-term fundamentals of the companies he invested in. He also had a knack for spotting industries that were undervalued or in the early stages of growth. For example, Lynch made a number of early investments in retail chains that were just starting to gain traction, like Home Depot and The Limited. These companies were on the cutting edge of retail, and Lynch saw their potential before they were widely recognized. The magic of the PEG ratio. Perhaps Lynch's most famous contribution to the world of investing was the development of the PEG ratio. The PEG ratio, which stands for price to earnings growth ratio, was a tool Lynch used to evaluate whether a stock was overpriced or underpriced based on its future growth potential. He argued that the price to earnings PE ratio, which is commonly used by analysts to value stocks, often didn't tell the whole story. A high PE ratio might indicate that a stock was overvalued, but if that company was growing rapidly, it could still be a great investment. Lynch's solution to this problem was the PEG ratio, which took into account both a company's PE ratio and its projected earnings growth. If a company had a low PEG ratio, it could be a sign that the stock was undervalued and worth considering. Lynch's approach to valuation allowed individual investors to evaluate stocks based on growth potential rather than just current price levels, helping them make smarter investment decisions. The Magellan Fund, performance and strategies. The Magellan Fund was the star of his career, and its performance was nothing short of remarkable. When Lynch took over the fund in 1977, it had $20 million in assets under management, AUM. By the time he stepped down in 1990, the fund had ballooned to $14 billion in AUM. Over this 13-year period, the Magellan Fund posted an average annual return of 29.2%, a performance that beat the market by a wide margin. Lynch's ability to identify high-growth companies combined with his focus on long-term investment helped him achieve extraordinary returns for his investors. Retirement and legacy. In 1990, Peter Lynch shocked the investment world by retiring at the age of 46. He had reached the pinnacle of his career, and after achieving legendary status, Lynch decided to step away from the spotlight to spend more time with his family. His decision to retire early didn't mark the end of his influence, however. He remained an active figure in the investment community, writing several best-selling books, including One Up on Wall Street and Beating the Street, where he shared his investment philosophies with a new generation of investors. Lynch's ability to communicate complex financial concepts in simple terms made him a beloved figure among individual investors. Through his books, Lynch taught millions how to think like an investor, how to identify potential investments, and how to avoid common pitfalls. He never stopped believing in the potential of the average investor, and his belief that anyone could learn to invest effectively resonated with people around the world.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it.